Welcome back to the deep dive. Today we're looking at CME Group's third quarter results for 2025. They just came out October 22nd. And our goal here really is to dig into how the world's, leading derivatives marketplace performed, especially with all the global uncertainty they mention. How did they actually maintain their financial health?
Well, the first thing that jumps out, I think, is what the CEO, Terry Duffy, highlighted. He basically said that despite everything, they managed adjusted net income and adjusted earnings per share that were on par with Q3 last year.
And last year's Q3 was considered exceptionally strong, right?
Exactly. So being on par suggests some real resilience. It wasn't about massive growth this quarter. It was about holding steady at a very high level. That tells you something important.
Okay, let's lay out the basic numbers first. Q3 2025 revenue, $1.5 billion. And the standard GAAP net income was $908 million.
Which translates to a GAAP diluted earnings per share of $2.49. Solid numbers for sure.
But like you said, that's not quite the full picture they want to paint.
Right. For a company like CME, you really want to look at those adjusted figures. They strip out certain items, things that don't reflect the core day-to-day operations.
So what were the adjusted numbers?
Adjusted net income was $978.4 million, so about, $70 million higher than GAAP?
Yeah.
And the adjusted diluted EPS was $2.68.
Why the gap? What gets adjusted out usually?
Typically things like amortization of intangible assets, maybe some merger costs if they had any certain tax things. The source mentions non-cash items here. It just gives theoretically a cleaner view of cash generation from trading and clearing.
And that $2.68 adjusted EPS, that's the key figure.
That's the one. Because, as we noted, it was exactly the same as Q3 2024. Holding that peak level for a whole year amid all the turbulence they talk about, that suggests, some serious structural efficiency.
They must have managed costs really well, or maybe the mix of products traded worked in their favor.
Could be both. It certainly points to efficiency. And this ties into what Duffy said strategically. He stressed that clients globally used CME markets across all asset classes.
Right, for risk management and finding opportunities. That sounds like they're leaning into being essential plumbing for the financial system.
Pretty much. It means they're seen as the go-to place, the utility you have to use to hedge, no matter what's happening globally. That reliance across rates, equities, commodities, it's their competitive advantage. It gives them pricing power, stability.
And operationally, they backed this up by hitting their second highest Q3 average daily volume, or ADV.
Yeah, that high volume is the evidence. Clients weren't just sitting on the sidelines. They were actively using CME products to manage their exposures.
Okay, now this is where it gets really interesting for me, the future focus. Duffy mentioned efficiencies, new products, expanded access, but two things specifically caught my eye.
Which were?
The new partnership with FanDuel and offering 247 trading in our cryptocurrency futures and options.
Ah, yes. Those definitely signal where they might be heading. The crypto part seems like a maybe more natural extension, offering regulated futures and options on digital assets for institutional players. It fits the risk management theme, arguably.
Okay, I can see that. But FanDuel, sports betting company, how does that fit with institutional risk management? Seems like a big departure.
It is a significant move, no doubt. It's clearly a push into new potential growth areas. They aren't becoming a sportsbook themselves, but they're offering regulated derivatives linked to those outcomes.
So leveraging their clearinghouse reputation, guaranteeing trades in a totally different kind of market.
That seems to be the play. They're positioning themselves as the ultimate clearer of risk, even if that risk comes from, sports outcomes rather than interest rates or oil prices. It's definitely expanding the definition of their core market.
Okay, so to fund these kinds of strategic moves, they need solid core revenue. What did that look like in Q3?
Well, the main engine is still clearing and transaction fees. That brought in $1.2 billion.
Right, that's the bulk of it.
But the other piece, which is incredibly important for stability, is market data revenue. And that hit a record, $203 million for the quarter.
For a record, $203 million just for market data. Wow, that's like the subscription fee everyone has to pay just to play, right? Very stable income stream.
Extremely stable and growing. Compare that $203 million to Q3 last year was $178.2 million then. That's a solid increase.
Yeah, that kind of predictable growth is gold. It lets them invest in new tech, new partnerships, like the ones we just talked about.
Exactly. Now let's look at the price they get per contract, the RPC, or rate per contract.
How did that trend?
It went up. The total average RPC for Q3 2025 was 0.702 SAR.
Okay, and how does that compare?
It's up from 0.6666 in Q3 2024. So they're collecting more. on average for each contract traded.
Which is crucial, right? Especially if overall volume fluctuates. Getting more per trade helps maintain profitability.
Absolutely. And that increase often comes down to the mix of products being traded. Some products just command higher fees than others. If the more expensive products see more action, that average RPC goes up.
Let's dig into that trading activity then. The average daily volume, ADV. You mentioned it was the second highest Q3 ever. The overall number was 25,322,000 contracts daily.
Correct. About 25.3 million contracts a day. Now, it's worth noting that is a bit lower than earlier in 2025.
Oh, how much lower?
Well, Q1 averaged almost 30 million contracts a day. Q2 was just over 30 million. So Q3 saw a bit of a cooling off from those peaks.
Suggests maybe the extreme volatility from the first half of the year eased off a bit?
That seems likely.
Yeah.
But still, 25 million contracts a day is a very, very busy market. Lots of risks still being managed.
Okay, so where was that volume concentrated? Which asset classes?
Interest rates dominated massively. 13,378,000 contracts daily. That's well over half the total volume.
Reflects the global focus on rates and central banks, I suppose.
Undeniably.
Huh.
After rates, the next biggest was equity indexes at about 6.3 million contracts. Then you had the physicals, energy at nearly 2.3 million, ags at 1.7 million.
And the smaller segments?
Metals were around 825,000 contracts, and foreign exchange was actually the smallest segment by volume in Q3 at about 834,000.
Interesting. Now, how are people trading this stuff? Is it still happening in the pits?
Not much anymore. The overwhelming majority is electronic. CME Globex, their platform, handled 23,418,000 of those daily contracts in Q3.
Wow, so over 90%.
Easily. Open outcry was under 1 million contracts a day, and privately negotiated trades were also just under 1 million. CME is fundamentally a tech company running an exchange these days.
That makes sense. And you mentioned the product mix affects the average fee, the RPC. Can we see that in the data?
Oh, yeah, definitely. Look at interest rates. Huge volume, right?
Yeah.
13.4 million contracts. But their RPC was the lowest of all asset classes, only 0.487 per contract.
The biggest segment pays the lowest average fee. Why is that?
Think standardization and scale. Interest rate futures are incredibly liquid, very standardized. It's like a commodity product on the exchange itself. Huge volume, super competitive, so the fee per contract is thin. They make it up on sheer numbers.
Okay, so what's on the other end? Which product has the highest fee?
That was foreign exchange. Much lower volume, remember, under 1 million contracts. But its RPC was the highest at 0.841 cents.
Almost double the interest rate fee.
Exactly. These might be slightly less standardized contracts, maybe require more complex clearing, serve a more niche clientele. It's the difference between, say, a mass market highway toll and an express lane fee for specialized vehicles. Both contribute, but in different ways, to that overall average RPC of 0.702 taus.
All right, let's shift gears slightly to the company's foundation, its balance sheet. How did things look at the end of September 2025?
Pretty solid. They had about $2.6 billion in cash on hand, including restricted cash.
And debt levels?
Long-term debt set at $3.4 billion. For a company of this size and profitability, that seems quite manageable. It's strategic debt, not distressed debt.
And that financial strength allows them to do what?
Return a lot of capital to shareholders. This is a big part of the CMB story. They have this variable dividend policy implemented way back in 2012.
And the total return since then?
Get this. Over $29.5 billion. Billion dollars with a B. Returned to shareholders as dividends since early 2012.
That is staggering. It really underscores their cash-generating power.
It absolutely does. And just looking at this year, 2025, in the first 9 months alone, they paid out roughly $3.5 billion in dividends.
So the message to investors is clear. We generate tons of cash, more than we need for operations and growth, and we give a large chunk of it back to you consistently.
That's the core value proposition for shareholders, yes. Hashtag outro.
Okay, so let's wrap this up. The Q3 story for CME seems to be one of maybe not explosive growth, but certainly stability and underlying strength.
I think that's right. That flat year-over-year adjusted EPS, the $2.68 is the headline. And it was achieved, it seems, through good cost control, that rising RPC driven by product mix, and the record performance in market data revenue.
So for you, the listener, what's the key takeaway? CME Group isn't just a place where futures trade. It's really this core infrastructure for global risk management.
Yeah, across everything. Rates, equities, FX, crypto now, energy, agriculture, metals. They cover the waterfront.
Which brings us to our final thought. They pitch themselves as the place for managing institutional risk. But we talked about the FanDuel partnership, the 24/7 crypto trading. These feel different.
More retail adjacent. maybe more speculative potential.
Exactly. So here's the provocative thought for you to consider. As CME integrates these newer, arguably more volatile, maybe even consumer-facing assets, what does that do to its identity?
How does incorporating things like sports betting derivatives or highly volatile crypto assets mesh with the traditional role of a systemic clearinghouse, one that's meant to guarantee stability in core institutional markets?
Does it change their risk profile? Does it attract different regulatory scrutiny? It's a fascinating tension.
It really is. Balancing that core utility function with the hunt for growth in these adjacent, maybe riskier areas, something we'll definitely keep an eye on. Until the next deep dive, keep learning.